Alright, so let's talk about crypto. We all know it's the wild west of finance, right? One day your portfolio is going to the moon, and the next it feels like it's drilling to the center of the earth. This incredible volatility is what draws a lot of people in, but it's also what makes it so incredibly difficult to trade. You can't just throw your money at a coin with a cool name and hope for the best. Well, you can, but I really wouldn't recommend it if you want to stay in the game for longer than a week. You need a strategy, you need tools, and you need a way to make sense of all the chaotic price action. That's where technical indicators come in, and let me tell you, they are an absolute game changer, especially in a market that runs 24/7 like crypto. Unlike the stock market, which has opening and closing bells, crypto never sleeps. This constant movement means there's a ton of data to analyze, and these indicators are designed to cut through that noise. They help you understand the market's momentum, identify potential trend changes, and frankly, just make more educated guesses instead of gambling. They're not a crystal ball, but they're the next best thing to give you an edge over everyone else who's just trading on pure emotion and hype. So, if you're tired of getting wrecked by surprise dumps or missing out on massive pumps, you need to stick around. I'm going to break down the absolute essential indicators that I believe every crypto trader, from beginner to pro, should have on their charts. We're not just going to talk about what they are, we're going to get into the nitty-gritty of how to actually read them and use them to make smarter trading decisions. So, get your coffee, smash the like button for the YouTube algorithm. Here are the top crypto trading indicators and how to use them. Okay, first up we have an absolute classic, the Relative Strength Index, or RSI. If you've ever looked at a trading chart, you've probably seen this squiggly line at the bottom, and for good reason. The RSI is what's called a momentum oscillator. In simple terms, it measures the speed and change of price movements on a scale from 0 to 100. Its main job is to tell you if a cryptocurrency is potentially overbought or oversold. Think of it like a car's tachometer. When the needle goes into the red zone, you know the engine is being pushed too hard and might need to cool down. The RSI works in a very similar way for asset prices. The magic numbers you need to remember are 70 and 30. When the RSI line goes above 70, it's generally considered a signal that the asset is overbought. This doesn't mean you should immediately hit the sell button, but it's a warning sign. It suggests that the buying pressure might be getting exhausted and a pullback or reversal could be on the horizon. Conversely, when the RSI dips below 30, it signals that the asset is oversold. This is where you might start looking for buying opportunities, as the selling pressure could be running out of steam, and the price might be due for a bounce. It's an incredibly useful first-glance tool in the fast-moving crypto world, but here's where it gets really powerful. Divergence. This is when the price of the crypto is making a new high, but the RSI is making a lower high. This is called a bearish divergence, and it's a huge red flag that the upward momentum is weakening, even though the price is still climbing. The opposite is a bullish divergence, where the price hits a new low, but the RSI makes a higher low. This suggests the downward trend is losing its power. Spotting these divergences early can give you a massive advantage and help you anticipate trend changes before the rest of the market catches on. It's an indispensable tool for navigating those crazy crypto swings. Next on the list is another heavyweight champion of indicators, the Moving Average Convergence Divergence, or MACD. I know it sounds super complicated, but I promise it's easier to understand than it sounds. The MACD is a trend-following momentum indicator, and its whole purpose is to show you the relationship between two different moving averages of an asset's price. It consists of three main parts you need to watch: the MACD line, the signal line, and the histogram. Getting a handle on how these three elements dance together is key to unlocking the MACD's power to identify when a trend is starting, ending, or reversing. So, how do you actually read this thing? The most basic signal is the crossover. When the MACD line, which is the faster moving line, crosses above the signal line, it's considered a bullish signal, suggesting that momentum is shifting to the upside and a new uptrend might be starting. This is when you might consider looking for entry points. On the flip side, when the MACD line crosses below the signal line, it's a bearish signal. This indicates that momentum is shifting downwards, and it might be a good time to consider taking profits or even looking for shorting opportunities. It's a straightforward way to get a feel for the market's direction. Just like the RSI, The MACD is also incredible for spotting divergences. If the price of Bitcoin, for example, is setting a new high but the MACD indicator is failing to do the same, and is instead making a lower high, that's a classic bearish divergence. It's a warning that the rally is losing steam from the inside out. Then you have the histogram, which is those little bars. The histogram visually represents the distance between the MACD line and the signal line. When the bars get bigger, momentum is increasing. When they start to shrink, momentum is fading. Watching the histogram shrink can often be your earliest clue that a crossover, and a potential trend change, is just around the corner. Alright, now let's get back to basics with one of the most fundamental and widely used indicators out there, moving averages, or MAs. Seriously, almost every trader uses them in some form. A moving average does exactly what its name implies. It calculates the average price of an asset over a specific number of periods, creating a single, smooth line on your chart. The whole point is to filter out the short-term noise and random price fluctuations to give you a clearer picture of the underlying trend. Is the price generally heading up, down, or sideways? The moving average will tell you at a glance. There are two main flavors you'll hear about: the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA is the straightforward one. It just takes the average price over a certain period, like 50 days. The EMA is a bit more complex. It also calculates an average, but it gives more weight to the most recent prices. This makes the EMA react more quickly to recent price changes, which can be a huge advantage in the hyper-volatile crypto market. A lot of crypto traders prefer EMAs for this exact reason, as a 2-day-old price might as well be ancient history in this space. So how do you use them? The simplest way is for trend identification. If the price is consistently trading above a key moving average like the 50-day or 200-day, it's generally considered to be in an uptrend. If it's below, it's in a downtrend. You can also watch for crossovers. The famous golden cross happens when a shorter-term MA, like the 50-day, crosses above a longer-term MA, like the 200-day, which is a very strong bullish signal. The opposite, the death cross, is a major bearish signal. Finally, these lines often act as dynamic support and resistance. You'll often see the price bounce off a moving average in an uptrend, providing great potential entry points. Now for an indicator that is tailor-made for volatile markets like crypto Bollinger Bands. If you see a chart with 3 lines that look like they're hugging the price action, that's them. Bollinger Bands consist of a simple moving average in the middle, which acts as a baseline, and then an upper and lower band on either side. These outer bands are typically set at 2 standard deviations away from the middle band. I know standard deviation sounds like you need a math degree, but all it really means is that the bands will automatically get wider when volatility is high and narrower when volatility is low. This is what makes them so powerful. The width of the bands themselves tells you a story. When the bands are very narrow and squeezed together, it's known as a squeeze. This often signals that the market is consolidating and a period of low volatility is taking place. But here's the kicker. A squeeze is very often followed by a big price move, a period of high volatility. It's like coiling a spring. So when you see the bands getting tight, it's time to pay close attention because a breakout in either direction could be imminent. This is your early warning system for an impending volatility explosion. Besides the squeeze, you can also interpret how the price interacts with the bands. When the price touches the upper band, it doesn't necessarily mean sell, but it does suggest the asset is becoming relatively expensive or overbought. Conversely, a touch of the lower band suggests the asset is relatively cheap or oversold. A common strategy is to look for bounces off the lower band as potential buy signals in an uptrend, and vice versa. Furthermore, when the price starts walking the band, meaning it's repeatedly pushing against the upper or lower band, it can signal a very strong, continuing trend. Last but certainly not least, let's talk about an indicator that focuses on something we haven't discussed yet. Volume. This is the on-balance volume, or OBV. It's a beautifully simple yet powerful momentum indicator that uses volume flow to predict price changes. The core idea behind OBV is that volume precedes price. A significant change in trading volume, especially from large institutional players or smart money, can happen before the price makes a major move. OBV tries to capture this by keeping a running total of volume. Here's how it works. If the price closes higher today than it did yesterday, All of today's trading volume is added to the OBV running total. If the price closes lower, all of today's volume is subtracted. That's it. The actual numerical value of the OBV isn't what's important. What you're looking for is the direction of the OBV line. A rising OBV line shows that positive volume is flowing into the asset, which is a bullish sign that helps confirm an uptrend. It suggests that buyers are more aggressive than sellers. A falling OBV, on the other hand, shows negative volume pressure and helps confirm a downtrend. The real magic of OBV, much like with RSI and MACD, comes from divergence. This is where you can get a real edge. Let's say the price of a coin is grinding higher, making new highs, but the OBV line is flat, or even worse, trending downwards. This is a massive bearish divergence. It tells you that despite the rising price, there's no real volume, no real conviction behind the move. The smart money isn't participating, and the rally is running on fumes, making it very vulnerable to a sharp reversal. Spotting this can save you from buying at the top right before a crash. It's an essential tool for looking under the hood of price action. So there you have it, the RSI, MACD, moving averages, Bollinger Bands, and OBV. These are, in my opinion, the absolute pillars of technical analysis for any crypto trader. But here's the most important takeaway of this entire video. You should never ever rely on just one indicator. The real power comes from combining them. You might use moving averages to identify the main trend, wait for the RSI to show an oversold condition within that trend, and then use a MACD crossover as your final confirmation to enter a trade. Creating a system where multiple indicators give you the same signal is how you increase your odds of success and trade with more confidence. And please, I cannot stress this enough. No indicator is a foolproof crystal ball that predicts the future with 100% accuracy. They are tools of probability, not certainty. The crypto market can be irrational and can be swayed by a single tweet or a piece of news that no indicator could ever predict. That is why having solid risk management is non-negotiable. This means using stop losses, only risking a small percentage of your portfolio on any single trade, and knowing when to cut your losses. Without risk management, even the best indicators in the world won't save you from blowing up your account. My advice to you now is to go open up a chart and start playing with these indicators. Add them. Look at their settings and see how they behaved on past price action for your favorite coins. There is no one-size-fits-all strategy. Some of you might fall in love with the RSI, others might find the OBV speaks to them. The goal is to experiment, backtest, and build a trading system that fits your personal style and risk tolerance. It takes time and practice, but learning to use these tools is a critical step on the path to becoming a consistently profitable trader. Thank you so much for watching, subscribe for more, and I'll see you in the next video.